after we had invested 1 million in the competence of people. Depreciation stays the same, so the total of common costs was 25 million, which made, when you deduct the common cost from the contribution, then you come to an operating profit, or Ebit, earnings before interest and taxes, which is 11. And who is again responsible in the company for this operating profit? Anybody? Who in Berge is responsible for operating profit?
Sales?
Sales? Big burden to carry them.
At the end, the CEO. It's not only sales, because sales can just work on the first line.
Yes.
Yeah. So who can work on other lines?
We have a head of operations.
Oh, a head.
Yeah.
You are a head, or you have a hat?
Yeah. Well, you know, to make it easy for you, actually, everybody who is in the operations is responsible for the operating profits. Everybody on their level, of course, and of course there are top managers and CEOs who have the responsibility of everything, but you can all influence, and like you rightly said, sales influence here. Cost of sales, by whom is that influenced?
Purchasing.
Partly.
Also operations, the plans.
Production. Yeah.
Production.
Yeah. Production. Yeah. Okay. And I would maybe also say anybody who is in research and development, because the better you develop it, that it is cheap to make, the more you influence the cost of sales. So that means that everybody in sales, production, research, development can influence that. Who influences overhead? Marketing, administration, HR, finance department, and anybody who is not in production and sales. So it's actually everybody. Every light you keep burning too long, every, I don't know, breakage you make, every travel you do, everything comes into overhead. Anything that's not allocated immediately to the cost of your goods sold. Development, who influences that? That's all the people in research and development. But if you add in kind of training and the process development, then it's more people. And depreciation, again, it's the finance department which will, you know, do the books of diminishing the value of your machinery, etc. But of course, everybody who maintains things well makes that maybe the fixed assets last longer than their official depreciation time. So in a way, we all influence the operating profits from inside the company or inside the operations. And that's the most fair kind of figure that we can get to compare one factory to another or one company to another. Because when afterwards you look at interest expense, well, that's depending on how you've been financed and in which country that the banks charge which interest rate. Profit before taxes, then come taxes, which is also depending on which country you are in. So you do not directly influence that inside the operations. That's why Ebit is called Ebit. Earnings before, those two outside, non-influenceable by you costs, interest and taxes. Okay. So when I now look further, we see the balance sheet. And you see here, I have it like you had it on your screen, not side by side, but one below the other. But the most important thing is that total assets, 66, is equal to total liabilities and equities, also 66. In the continent, so Germany, France, etc., we call that active or activa, and passive, passiva, the other side of the balance sheet. Okay. Do you see a link between the profit and loss statement and the balance sheet?
Last year business result.
Exactly, exactly. So the profit and loss statement is actually the movie we create from the beginning of the year to the end of the year. All the invoices that are being sent out, which is the sales, and then all the costs that we make, but they come day by day, by day, by day. And at the end of the year, we come out with a profit and loss, which we then put in the picture that we take at the end of the year, which is the balance sheet. And in that picture, the only thing from the profit and loss statement that is there is what we have here. Yeah. And of course, also something, because we did calculate taxes, but we didn't pay them yet. So they came into the short-term liabilities. So if you just remember, profit and loss statement is like the movie, and the balance sheet is really a picture taken at a certain moment. And that is mostly when you close your book at the end of a fiscal year. We then looked Tuesday, at the graph where we have put all the figures from the profit and loss statement here on the top and of the balance sheet here on the bottom, in order to look how figures compare to each other. Because an operating profit of 11 million may be small for Berge, but it would be huge for Claudia and me, for instance. It doesn't say much. It's only when you compare it to the assets that you get to this percentage, which tells you how well did you use the assets that you have been keeping in the company, which we did move from 9 to 17%.
Sorry, one question regarding this.
Yes.
Just to translate to Spanish, because it's difficult for me with these technical words. The return of assets is the economic return and the equity is the financial return.
No, I don't know the word economic return.
The return of investment.
Return on, because you could also call it return on investment, which is in projects. It would be return on investment, and for an entire company, the investment is actually the sum of all the assets. They call it return on assets, and there is also a word return on capital employed. So on all the capital that you've been binding.
Mm-hmm.
But I look up if I find the Spanish word, because we have other oranges in Spanish as well. So I'll look it up for you.
There is a deep, wait a minute. I have it in a minute. Rendimiento del activo.
Okay.
Okay.
Now it's clear. Now it's clear.
Claudia. The return on equity, so in English, equity is what we would say is it's the money that the owners or the shareholders have put into the company. So it is called, don't have the word in the other. In German, Claudia? Equity?
Equity, Eigenkapital.
Eigenkapital. Eigenkapital, yeah. Et capitaux propres en français. That return is really what interests the shareholder or the owner of the company. If imagine you had inherited 43 million and you put it in a company, then when you get 14%, you would be very happy. But here the shareholder before who put in his 39 million only got 5% for taking risks. So that's not so good. So here we look at how the operating profit before interest and taxes is compared to the assets. And that's the cleanest figure with which you can compare one factory to another or one company to another. All this, that is depending on the external situations.
So I have a
these
question.
Yes, hope I have an answer.
So what is the linkage between return on sales and EBIT? So for example, when we make calculation for our products, we focus in terms of profitability about return on sales. While when we make our reports, we report and we focus then on the EBIT on the product.
Yeah. So
how can we make this comparable, the ROS with the EBIT?
You call it Ebit, yeah. Okay.
EBIT.
So,
yeah.
When you look here, that was also an indicator that you could fill in. Huh? So the contribution margin is what you would call the return on sales, and it's the profitability of your product. If you read what is written here, it's a matter of how much you get for your product, the price that you get from your client, 60 in this example, compared to what it has costed you to make them. Yeah. So you made it 36 goods and you sold them for 60. So your contribution on sales is 60%.
So then it's a little bit different in our company because we divide into two contribution margins, margin 1, margin 2. Margin 1 stands for the cost of the product. Then we have margin 2, which is basically the indirect costs, which are not linked to the product from my perspective. And then we have at the end of the day, what is the contribution of the remaining contribution of the product, which we achieved in order to make really the profit for the company. So after all costs.
And that's what comes here when we call the operating margin, or also the EBIT margin would be because you got a contribution of 36, but in the end, when you deduct the 25 million of common costs, you only had an operating profit of 11. So here, your operating margin is only 18% compared to your sales. Okay, so if I go back here, you say your sales, your contribution margin here on sales, or that's the first one you calculate, is 36 on 60. And the EBIT margin or operating margin is 11 to 60. Yeah.
And then we have also the net profit to sales. This is the third one. Then we have them all.
Yeah. Also do this one to sales. And that's the great thing about this graph, because you can compare anything with anything here. And you can also see, like, for instance, last year, we had 60 sales and 36 contribution. So our contribution margin was the same as this year. There was nothing changed. Yeah. But your operating margin has changed because it was 9 to 60, now 11 to 60. I'll show it again here. This was 9 to 60, only 15%. And here 11 to 60, 18%. Yeah. So when you then look again at this Dupont graph, you can say, okay, but how come that this is better now? Well, you can see we have improved, not because we were better in sales price or in cost of goods sold. No, we were better in common costs. So then we know, okay, now we might want to focus on sales and contribution of the sales. And it's when you look at these graphs, and that's why they're called key indicators. When you look at them, you know where there is still margin to improve. And here clearly, our contribution margin could be a candidate for improving further here in year 2. So that was that one. And there is a last one that you did yesterday. That was the equity ratio. And there was actually a question that mostly the banks ask. It's the proportion of owner's capital in the total capital that you have in your company. So here, the equity is 43 and the assets are 66. So the owners own 65% of the company. Whereas before, when we had that big loan, the owners only had 39% of the company. When we had 60 million loan. And that is important for the bank because where is the risk capital? That's the owner's capital or the equity. So the banks do not want to take risks. So the more percentage the owners take on themselves, the easier the bank have to give you an extra little loan. When that percentage is too small, you will not get loans anymore.
What
and
is
that
it?
is called solvability or stability. Sorry?
Excuse me, one question, Philip here. What is a good value and what is a not so good value for this equity ratio?
Yeah, so I would say a good value is when you have enough own capital that the bank feels good with you, but as little as possible, because the capital of the owners is always more expensive than bank loans. And so it's really balancing out, because if I have less own capital, then I, like now where the owners want to earn 14%, it's a big amount of money. Risk capital is more expensive than the capital of the bank, but it is a risk capital. And that's the balancing.
But still the companies would like to have to earn more and save more money for equity, because the situation will not stay like this forever. And a lot of people in the capital market are afraid that that Mrs. Yellen or whoever is in the central banks put up the interest rates again, and then you are sitting on a big amount of loans which you have to pay more interest. So it's the risks on one side and the other, so you have to balance it. In the very old days, it was like you buy a house. You should have 1/3 for your own, this is like even in the Middle Ages they say this. 1/3 is your own and the rest can be rent, loan. But it depends a little bit on which age you are. If you are a startup, you don't have much money. You start with a minimum. And the older you get, you can see this also in the age of a company. The older they get, the more equity they have.
Yeah.
Huh?
So Philip, there is no real rule. Exactly. It's that balancing that fits with your risk and a risky business will need more own capital because it won't get foreign capital. And a stable business which will be able to borrow money, but have to pay interest outside.
Yeah. And the big companies don't go to the banks anymore. They have their own bank. So they try to keep the money inside.
So I did this little tour with you to enable you to read balance sheets better. Because that can, and especially for you in sales, could be interesting before you sell to a company, to make sure that they are stable, that they can pay you, to can see that out of the balance sheets of your company.
I think the OEMs have this big problem. They just don't pay because they don't want to.
Okay, so what we
Thank you.
will
That
do
was good. I even recorded it for you, so we can use this as a resource.
Oh, super. Thank you, Claudia. Okay, so I think now